Hello, traders. Gary Wagner here. 1 o'clock in Honolulu, 6 o'clock in New York on Friday. Happy Aloha Friday, as we say on the islands. It is the 10th day of March, 2023, and this is the Weekend Review. Traders, today the government released the most current jobs report, which was expected to come in just around 200,000 and came in well over estimates at over 300,000. That would have created the ammunition the Federal Reserve needed to enact a 0.5% rate hike. But what was unexpected was the unemployment numbers. They were anticipated to come in at 3.4%, a downtick from the previous month of January. That rate hike moved gold phenomenally higher, up $38, with the most active April contract currently fixed at $1,872.70. That also put strong pressure on the dollar, taking it lower, and after trading to a low today of 104.02, the dollar index closed just off of that low at 104.62. Lastly, silver had a strong gain today of 2.18%, traded to low of 19.94.5 cents, a high of $20.87, and settled at $20.16.5 vis-a-vis the March futures contract. Traders, a lot has happened since last week's weekend review. I remember it as if it was yesterday because I was upset at the fact that on Tuesday of last week, after we saw a really strong potential for a bottom, we put a price order in to buy April gold at 1,828. It was a limit order, and the next day, the low was 1829.60, and it was up and away from there, in which we saw gold trade above 1860. However, that changed a few days ago when Chairman Powell testified before the Senate in a 2-day semi-annual event, and we saw gold sink like a rock, moving from just below 1860 and settling some $40 lower at approximately $1,820. We had that limit order still in as a good till cancel order, and obviously our entry price at 1828 was filled just a few days ago. The following day, we saw it trade down lower, trading to a low, I believe, of 1812 above the most recent low that came in at 1810. And then we saw it pick up a little bit on Thursday. However, I was concerned with the jobs report coming out if it came in above expectations. Well, it did. However, what also came in above expectations was the unemployment, which was supposedly going to tick down. Instead, it ticked up from 3.5% to 3.6%, and that propelled gold tremendously up about $40, ending the day shy of the 50-day moving average, which is currently at 1874.10. Now, we went long at 1828, but we also had an initial stop at 1808. That was based upon the 200-day moving average and below this particular low at 1810. That was the primary reason for putting it there. But this morning, as you know, we sent out a trade alert and we moved our stops up to 1849.30, which is right here. We are looking at a daily chart, but you'll get a better assessment when we convert this daily into an intraday chart. And traders, that's exactly what I've done. We're looking at a standard candlestick chart, although this candlestick chart is in an increment of 480 minutes. And when we look at it this way, disregard these moving averages because they no longer represent daily moving averages, but take a look at this stock and where it falls in terms of recent history. We absolutely needed to make sure it was below this particular high and this smaller high, and it comes in an area where we have seen it act as resistance in the past. Regardless of what happens next week, and I'm hoping it continues higher, the next chart will talk about the price points that we would want to see if gold moves above the 50-day moving average, which sits right about here. But suffice it to say, we bought at 28. We've locked in a profit between 28 and 49, so about $20 or $2,000 per COMEX contract. That is a tremendous turnaround from the way I felt when the order was initially filled at the beginning of this week. Traders, obviously, on a technical basis, a logical point to look for resistance would be the 50-day moving average. That comes in right here just above the closing price of 1872. But if we get a solid break and open on Monday and we see a CPI report that shows inflation is building but moderately, we should see gold continue to move higher. If that happens, our first target is going to be $1,893 because that would represent a 50% retracement from the data set that we have been using, which in essence begins at $1,811 and concludes at the recent high that occurred at $1,973 and then concludes at the recent lows that came in the other week at approximately $1,810. And that 50% retracement is important, but above that is the most critical Fibonacci retracement. That's at $1,911, and that is the 61.8% Fib retracement. And if that occurred, we would see our subscribers profit from that trade to the tune of about $80 per COMEX contract. That would be my most optimistic upside target. This final target at 1973, I do not believe will occur very soon. We'll probably see a couple of peaks and valleys before that point. But lastly, before we start hitting any of these targets, not only do we have to overcome the 50-day moving average, but I've just added the 38.2% Fibonacci retracement level, which comes in at 1873.80. And so we've got a double technical scenario that we need to overcome before we see gold prices continue to move higher. And traders, I highly recommend that you have a peaceful and restful weekend because come next week, it starts all over again with the release of the most current inflation report vis-a-vis the CPI. This has been Gary Wagner, wishing you as always good trading. We will talk to you after the weekend. Bye-bye.